This is a revision of Advanced Audit and Assurance for the exam period March-June 2019, and the question 1, subject audit planning for Margot Co. From audit manager to audit engagement partner. Ben Duval. Introduction. These briefing notes are prepared in respect of audit planning for our client, Margot Co., with a financial year ending 30 June 2019. The notes begin with the evaluation of the significant risks of material misstatement, which should be considered in planning the audit. The notes can then contain the audit procedures which have been designed in relation to two matters: the impairment of property, plant equipment, and capitalized development costs. A discussion is provided on the use of an auditor's expert in the audit of the company's biological assets. Finally, a member of client staff has alerted us to some suspicious behavior, which could indicate the breach of law and regulations. The notes discuss the issue and recommend actions to be taken by our firm. A. Evaluation of significant risks of material misstatement result from primary analytical procedures. The limited analytical procedures which have been performed indicate several potential risks of material misstatement. First, the current ratio has increased significantly from 1.4 in 20X8 to a projected figure of 2.6 in 20X9. Using the information provided, the current liabilities in 20X8 was $1.564 million, 2.19 million, divide 1.4, and are projected to be $1.280 million in the 20X9, $3.35 million, divide 2.6. Current assets are projected to increase by 53% and current liabilities projected to reduce by 17.6%. Given that the government accounts show that the cash balance is relatively static, this is a risk that other current assets, presumably inventory and receivables, could be overstated. However, the increase in current assets can be at least partly be explained by the inclusion of the $450,000 prepayment relating to restoring the damaged factory. This is discussed in more detail later in the briefing notes. There is also a risk that the current liabilities are understated. The risk is particularly significant given the, according to the finance director, current liabilities includes the provision of $450,000 in relation to restoring the damaged factory. The projected movement in the gearing ratio is small, from 32% to 28%. This fall in the gearing ratio is inconsistent with the fact that the company has taken a loan of $375,000 to finance the research and development. The expectation would be for the gearing ratio to increase unless there has been a repayment of finance of which we are unaware. Looking at the operating margin and return on capital employed, both ratios have improved by a small amount. This trend is worthy of scrutiny during the audit, as the offers and discounts offered to customers by the company should act negatively on margins and profitability, so the improvements in ratios could indicate the potential overstatement of operating profit. Another trend which is worth further investigation relates to online sales, which are projected to increase by 90.5% in the year. This is a significant increase, and what the finance director has asserted that the increase in sales is due to the success of the advertising campaign. This needs to be corroborated further. This is a risk of overstatement of revenue in relation to online sales, which is explored in more detail below. This is also a risk that the revenue from other sources is overstated. Excluding online sales, revenue from other sources is projected to increase by 5.3%, a significant increase, which could also indicate overstatement of revenue. Management bias. This is a private company where a majority of shares are owned by the Margot family. This brings the risk of management bias, especially as one of the family members is the company's chief executive officer, who is in position to influence the financial statements. The extract from the management accounts show that a significant dividend payment is made each year. So there is an expectation from the family members that the company will make sufficient profit to be able to pay this difference each year. This is therefore a significant inherent risk at the financial statement level that profits will be overstated. The risk that the financial statements are being deliberately manipulated is indicated by the accounting treatment applied to impairment, which is discussed in more detail below. Online sales. The online sales make up an increasing proportion of the company's revenue. According to management accounts, online sales are projected to represent 7% of total revenue in 20x9, 4% to 20x8. Online sales can bring a numerous of material misstatements. For instance, cutoff and timing of revenue recognition can be problematical. In the case of Margot, risks attached to the discounts, which are offered online sales as the discounts offered to customers appear to change frequently. This brings some complexity into the accounting, and the company should ensure that internal controls are operating effectively so that the accounting system is updated whenever the level and range of discounts and offers to customers change. Revenue could be over or understated if discounts are not accounted for appropriately, either because the discount is not recorded at all by the accounting system or if applied to wrong products. Research and development. In this financial year, $220,000 research and development costs have been capitalized as an intangible asset. This represents 1.8% of total asset and 10.5% of profit before tax and would be considered material to financial statements. This relates to research and development into new plastic-free packaging. According to IAS 38 intangible assets, a distinction has to be made between research costs, which must be expensed, and development costs, which should only be capitalized. If certain criteria met, including that the technical and commercial feasibility of assets has been established, it appears that the full amount paid to ProPack has been capitalized, which indicates that no distinction has been made between research costs and development costs. Only development costs can be capitalized, so there is a potential overstatement of intangible assets if it includes the research costs, which should be expensed. This means that the entity must intend and be able to complete the intangible asset and either use it or sell it, and be able to demonstrate how the asset will generate future economic benefits. This is the first risk of material misstatement because costs, which are developed costs, may have been capitalized, but the necessary criteria demonstrating that an asset has been created have not been met. Given that ProPack is only at the state of testing prototypes, it appears that there is not yet demonstrable evidence that the new packaging is technically feasible, or that Magotco will be able to use the packaging. In addition, there is problems in demonstrating that Magotco has control of the development of new packaging, given that the development has been outsourced to another company. In this case, the IAS 38 criteria for capitalization do not appear to have been met. This will result in overstatement of intangible assets and understatement of operating expenses. Impaired factory. The carrying amount of the impaired factory is material to financial statement. To statement of financial position representing 7% of total assets. The damage to the factory has triggered an impairment review as required by IAS 36 impairment of assets. However, the finance director has not prepared the impairment calculation in accordance with IAS 36. As specifically, the recoverable amount has not been correctly determined. The recoverable amount is the higher value in use and fair value less cost to sales the asset. However, a review of the calculation provided indicates that the determination of value in use is not correct. According to the IAS 36, cash flow projections, which are used to determine the value in use of the impaired assets, should relate to the asset in its current condition. Expenditures to improve or enhance the asset's performance should not be anticipated. The finance director's estimate of value in use is based on the assumption that the building is repaired and new machinery purchased. Neither of these assumptions should be included in the determination of value in use. It is likely that the value in use, when properly determined, is much lower than the finance director's estimate, meaning that the impairment loss to be recognized is greater than the $210,250 as per finance director's calculation. This is also a risk that the fair value less cost to sell is overestimated. If the factory is damaged and the machinery needs to be completely replaced, then the value of $135,000 included in management's calculation may be very optimistic. Therefore, there is a risk that the impairment loss is understated and the carrying value of asset is overstated. Provision for restoring the damaged factory and acquiring new machinery. Related to the point above, the financial statements include a provision for repairing the factory and building new machinery. A provision should only be recognized if it meets the criteria of IAS 37, provision contingent liabilities and contingent assets, including that there is a present obligation as a result of past event, and that a probable future outflow of economic benefit which can be reliably estimated exists. In this case, there does not seem to be a present obligation. The company is not contractually obliged to repair the damage, and there is no evidence that the constructive obligation exists. Neither does it appear appropriate to recognize a prepayment for an expense which has not yet been incurred. Therefore, the provision and related prepayment should not be recognized, and unless an adjustment is made to the financial statement, both current assets and current liability are overstated. The amount recognized represents 3.6% of total assets and is material to statement of financial position, though it has no impact on profit. Software and advertising costs are capitalized. During the year, software development cost of $30,000 and advertising cost of $225,000 as capitalized as intangible assets. The advertising cost as material, representing 1.8% of total assets and 10.7% of profit before year. For the year. The advertising costs have been incurred to support the Fruiter's Gold brand name, and the finance director justified the capitalization on the ground that advertising expenditure has led to an increase in sales. However, IAS 38 specifically states that advertising and promotional costs must not be recognized as intangible assets and must be expensed. Therefore, intangible assets are overstated and operating expenses understated by a material amount. The software development costs represent less than 1% of total assets and only 1.4% of profit, so are not considered to be material to financial statements, and therefore, in isolation, do not represent a significant risk of material misstatement in monetary terms, especially given that according to IAS 38, it is appropriate to capitalize internally developed software costs, assuming that the cost incurred give rise to an asset. However, this matter is being highlighted because the finance director has used a similar justification for capitalizing the advertising costs, which are likely to be materially misstated as discussed above, and therefore this gives rise to a general concern over whether all costs relating to intangible assets are being treated appropriately. Identification and potential misclassification of assets. There is a risk that the agricultural assets are not identified or classified appropriately, which will have an implication for the valuation of assets. For example, it may be difficult to distinguish between beer plants and fruit growing on the trees, and it might be hard to identify the state of development of fruit on the tree. The potentially impacts on the valuation of assets because beer plants are measured at cost and depreciated in accordance with IAS 16 property, plant and equipment, whereas the fruit should be measured at fair value in accordance with IAS 41 agriculture. B. Audit procedures for impaired factory. Obtain management detailed calculation to gain understanding and allow evaluation of methodology and assumption used, the basis of determining the fair value and the future period over which value in use was determined, and the discount rate used to calculate the present value of future cash flows. Discuss the methodology and assumptions with management to confirm their rationale. From the non-current asset register, confirm the carrying amount of cash-generating unit prior to any impairment being recognized, and confirm the carrying amount of each component of cash-generating unit. Obtain a copy of the company's insurance policy and review the terms and conditions to confirm whether the buildings and machinery are covered by insurance. Develop an auditor's estimate of the fair value less cost to sell and value in use in accordance with the IAS 36 requirements. Example, not including the restoration cost and replacement of machinery, and compared to the management's estimate. Developing an auditor's estimate would involve the following procedures. Obtain and review the report from the engineer to confirm the nature and extent of damage caused to the factory. Obtain and review any external valuation report. which the company has used as basis for fair value less cost to sell, and evaluates the reasonableness of any assumptions used in the valuation. For the value in use, discuss with management to obtain their view as to whether the factory has any value in use at all of its current state. Visit the factory to view the extent of damage caused by the storm and evaluate whether it can be used without any further capital expenditure. Consider whether the use of an auditor's expert is necessary to provide sufficient and appropriate evidence given the materiality of the figure. Part B. Research and development costs. Discuss the project to develop new packaging with management to develop an understanding of matters such as how the company intends to use the new packaging and the state of development reached by the year end and whether the project may need additional funding. Obtain and review progress reports and correspondence from ProPack, which will indicate the progress made so far. Obtain and review the contract with ProPack to determine contractual terms, and if the assets will be owned and controlled by Maggot and that ProPack does not have any continuing interest in the development once it is complete. After receiving client's permission, arrange to discuss the project with ProPack to obtain further understanding on the range of matters, including technical feasibility and results of the testing on the prototype. Discuss with the company's production and marketing directors to obtain understanding of how the company will use the new packaging. Obtain any financial budget prepared in relation to project to confirm the amount of expenditure which has been approved and the costs are clearly distinguishable by reference to the company's cash position and available finance. Evaluate whether Maggot Co. has sufficient funds to complete the development. Obtain samples of prototype packaging from ProPack to confirm existence. Agree the amount spent to date to invoices submitted by ProPack and to the company's cash records. C. Matters to consider before placing reliance on the work of the auditor's expert. ISA 620 using the work of auditors experts contains requirements relating to objectivity, competence, and capabilities of auditors experts, the scope and objectives of their work, and assessing their work objectivity. According to ISA 620, the auditor shall evaluate whether the auditor's expert has the necessary objectivity, and this should include querying regarding interests and relationships which may create a threat to the expert's objectivity. The audit firm will need to ensure that the expert has no connection to Magotco, for example, that they are not a related party of the company or any person in the position of influence over the financial statements. If the expert's activity is threatened, little or no reliance can be placed on their work, and the audit firm should not treat it as the reliable source of audit evidence. Competence. ISA 620 also requires the competence of the expert to be considered. This should include considering the expert's membership of appropriate professional bodies. Any doubts over the competence of the expert will reduce the reliability of audit evidence obtained. The expert should, in this case, have experience in valuing the fruit Which are the agricultural assets recognized in the statement of financial position, and be familiar with the framework for measuring fair value of these assets in accordance with IS 41 Agriculture and IFRS 13 Fair Value Measurement. Scope of work. The ISA 620 requires the auditor to agree the scope of work with the expert. This may include agreement of the objective of the work. However, the expert's work will be used by the auditor, and the methodology and key assumptions to be used in assessing the work performed by the expert. The auditor should confirm that the scope of the work is as agreed with at the start of engagement. If the expert has deviated from the agreed scope of work, it is likely to be less relevant and reliable. A relevance of conclusion. ISA 620 states that the auditor shall evaluate the relevance and adequacy of the expert's finding and conclusion. This will over consideration of source data which were used and the appropriateness assumption and the reasons for any changes in methodology or assumption. The conclusion should be consistent with other relevant audit findings and with the auditor's general understanding of the business. If the work involves using source data, which is significant to their workings, the audit team should plan to assess the relevance and completeness and accuracy of that data. Any inconsistencies should be investigated as they may indicate evidence which is not reliable. Part D. Audit implications of email from large